You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Thank you for being here and listening. I thought I would cover today a topic that I may have covered somewhat in an earlier podcast, maybe a couple of years ago. I just thought that I would cover it again and maybe have some additional ideas for this podcast, as I've been talking to a lot of people recently who are just unsure of the best way to fund their policy or don't have a lot of ideas as to where to get the funding or how to get the funding or how can they get started. They just want to know how they can get started. And so I thought I would share some ideas on how to get started on funding and how to fund, or where you could be looking for cash or resources that might be sitting in an account somewhere, sitting on the sidelines, not doing much for you. So I thought I would just point out some of these options, because oftentimes there is money sitting in other places or accounts that can be used to begin your policy, either as paid-up additions premium or to help cover, say, the first few years of total premium. So where are some of these places where the money could be sitting? Let's go through a list of some of these locations where you might have resources that you could move to begin your policy, or to help jumpstart your policy, as in moving the money to start your paid-up additions to be able to fund those paid-up additions in your account. So the first and most obvious location would be a savings account. If you have money just sitting in a savings account, I fully believe, and those of us who are practitioners, that moving that money to a whole life policy is going to do way more for you. There's just going to be way more benefits than if you leave those dollars in a savings account. For example, some features that you would expect to have in your savings account would be that your cash is guaranteed to be there, guaranteed to be there when you need it, or that it's liquid. We definitely want our cash in our savings account to be liquid. That's two of the features that we automatically know come with a savings account and safe, and that's why we use them. That's we know we can go to the money as soon as we need to, whenever we want, and it's going to be there. At least we hope it's going to be there, so long as the bank is stable and something crazy doesn't happen. Otherwise, going to be there. So, like, for example, the enactment of the Dodd-Frank Act, which I've spoke on before, where the government is not going to bail out banks if there's another catastrophe like there was in 2008, but instead the unsecured creditors will be the ones to bail out their bank if it goes down, and we are the unsecured creditors, the depositors. So those two features I listed are obvious that we would want in our savings account. Some other features that come with the whole life policy would be uninterrupted compounding interest, even if you need to access those funds by borrowing against your policy. That definitely doesn't come with a savings account at your bank. It's also very nice that our cash value in our whole life policies or life insurance policies, it's creditor protected. Now, I can't say that it's creditor protected in all states, but it is in most states, I would say. You have to check in your state to see if it is creditor protected, and they might have some different rules around that. But that's still an added feature, an added benefit that comes for whole life for most people. And also the fact that you can access those funds income tax free all your life, and they grow tax deferred. You can access them income tax free, and then they leave a tax free death benefit to your family. Those three things are over and above what you would be able to receive or any benefits you can expect from a savings account. Another place you might look for some resources, some funds to be able to move into your whole life policy as either paid-up additions or your regular premium, an investment account. Now, certain types of investment accounts, because remember that moving money from a retirement type of account will come with a penalty of 10% if you try to move those funds before you're 59 and a half. So it's going to be taxable unless it's a Roth IRA. There are some additional rules around the Roth IRA to access those funds without tax 100%. But There may be another investment account that you have money sitting in or that you have money invested in that you just would like to move it, you'd like to protect it, you'd like to see guarantees, and you're tired of watching it go up and down in the market or something like that. And so you want to use that because now you're going to lock in the guaranteed earning and not have to watch it go up and down. There may be an account you have like that that's not a retirement account. Certainly the industry frowns upon cashing out retirement accounts and putting that into life insurance. They definitely frown upon that. It's not that you can't do it, it's just that it's not encouraged by the financial industry. If that is something that you decide you would like to do, just keep in mind that the funds are taxable with a regular IRA, a traditional IRA, they will be taxable. And so keep that in mind. And also, if you're closing out chunks of that money, it could push you into another higher tax bracket. And now you have to pay attention to possibly being taxed at a higher rate simply because you are showing more income that year from moving some of that money. You may be considering a home equity line of credit. You may be thinking, I have this HELOC where I can access funds and I can move it into my policy and move it in as paid up additions to get it jump started. However, if that's something you're thinking about, just make sure you're very careful because you're going to have then a new HELOC payment. And if it has a variable interest rate, it could be going up and down, and you just don't want to be caught off guard with this giant payment that suddenly you're trying to juggle all these payments and it becomes difficult. There were certainly some agents that were encouraging this in the nation in recent years. And so now we have new rules in the industry because of advisors and agents suggesting and encouraging people to do exactly this. People who were not prepared, they were encouraging their clients to take a HELOC, go out and get a HELOC or use their current HELOC and use it to fund whole life policies or life insurance policies. And so now we have these new rules because of this, and they're looking for this because it's harmed some people. You've got to be careful. You can't just load up all your money and move it all over if you don't have a plan, if you're not thinking about how you're going to manage those payments or what your plan is going forward. It's not that it's an impossibility, maybe just not something you would plan your whole funding of your policy around. Maybe just as a fallback, you can lean on a HELOC if you have a year where you didn't have as much income or you're not able to fund at the level you wanted to. And maybe at that time, you might lean on your HELOC a little bit. You just want to be careful because accessing that money, taking some money from your HELOC, funding it as your paid up additions or into your policy, now you're going to have that HELOC payment, you're going to have your premium payments, and possibly a loan repayment to your policy if you are now taking loans. And so you want to make sure you're aware of all these things that you're planning for and that you have the resources to make sure everything works in your best interest and does what it's supposed to do. Maybe you have CDs that are sitting in the bank and you just keep letting them turn over and you get a new CD every time one is up, the time frame is up. And maybe that's some money that you'd like to move into some paid up additions for your contract. That's always an idea. Maybe you receive a tax refund every year or you generally get one, so you can expect to get one this coming year. You can always plan to be able to load those into your policy, even if you already spent this year's tax return, but you know you may be getting one next year. You can plan to start your premium that's affordable to you, either on a monthly basis or an annual basis. There's different kinds of premium modes. So you can plan for that potential influx of cash so that your policy is able to receive it without becoming a modified endowment contract. Maybe you are paying extra payments towards your house or paying more than the minimum requested on credit card payments. We could take this overage in payments and we could redirect those funds towards a policy and start capturing the earning power of those dollars for the rest of your life. And then once they're in your policy, we can then turn around and borrow against the funds and pay down the debts that you have to those outside banks. I was talking about this a little bit last week's regarding your mortgage, but certainly with credit cards or any other loans, we could do the same. Maybe you have rental income or are flipping homes, and that could be a place where you can get premium from and start directing it into a policy. Or maybe you just received an inheritance or you expect to receive an inheritance. Those funds could be used. We could use chunks of it to start funding the paid up additions, or we could use parts of it to fund the whole premium. Really just depends on what makes sense for you going forward. If it's an IRA that you've inherited, an IRA from a non-spouse, depending on when you received it, you are likely to have to spend it down in 10 years. those funds could be used to start a policy since you have to spend them down anyway. Just remember that those funds will be taxable. So whatever you're looking at, subtract out some tax if that's what you're thinking about using towards a policy. It may be that you have a certain amount that you would be able to afford towards your premium from your monthly household cash flow, and that you are just looking for ways to jumpstart the growth of your policy with lump sum funding of the paid up additions. Remember that those funds, the paid up additions, are available right away inside the policy. It's sort of like moving funds from one pocket to the other. So if you're having a hard time envisioning how you're going to begin your policy, it's possible that we would be able to reallocate funds, relocate them to your policy, maybe your paid up additions, or maybe more than that, maybe including your premium. And then you'll be able to start building your policy and start securing your financial future with a cash flowing asset that comes with guarantees, guaranteed cash value, and guaranteed death benefit. As always, if this is something you are feeling ready to begin for yourself and you would like to partner with me as your advisor, feel free to reach out. You can just shoot me an email to valerie@alphaomegawealth.com. I so look forward to meeting you and helping you start something great for yourself, your family, and your legacy. Have a great week.